Okay. Hi, everybody. My name is Katie, and today I'm going to be talking about financial wellness. Let's see. So, some of the things that I'm going to go over today, I'm going to introduce myself. We're going to talk about money basics and an intro to budgeting, and then savings overview, credit and credit reporting, and then we'll have a Q&A if anybody has any questions. So my name is Katie, like I said. I've been working in finance for about 4 years now. And in that time, I have been, soaking up all of my knowledge that I can and sharing that knowledge with others. And I've been a money coach to others as well. So a few things here about money basics in an intro to budgeting. So a budget is a plan for every dollar that you have. You can choose which type of budgeting plan works best for you. There's digital, there's paper, there's apps, there's Excel, whatever works for you. So here's an example of some types of budgeting methods. We have the 50-30-20 method. This one's probably one of the most popular. It takes 50% of your necessities. So 50% of your income is going to go towards your necessities like rent, bills. 30% is going to be towards your wants, and these might be like subscriptions and things like that. And then 20% you're going to go towards debt repayment and or savings. So if you have debt, you can put 20% of your monthly income towards that and get your 50 and 30% on wants. And if you really want to be aggressive with your debt repayment or savings, you can swap the 30 and 20% if you're feeling comfortable with that. So for example, if your income after tax is around $3,000, 50% of that is $1,500. So you have $1,500 to spend on rent, utilities, and on, so what? 30% is going to be about $900 for your wants, and then $600 towards savings or that debt repayment. Another method that a lot of people like to use is the envelope method, and this is physically putting cash into envelopes. So you take your cash out and you put in envelope 1 is going to be your rent, utilities, envelope 2 might be your groceries, envelope 3, car renter, insurance, subscriptions, whatever you need to do to separate that. I know a few people who have used this method successfully and they do like it very much. So you can also pay yourself first. That's one method that really helps you stay on your feet. So this puts your savings above your other expenses. And so you first want to determine how much you'd like to pay yourself from your savings. And then you can determine the remaining income for your immediate expenses. So for example, if you make the $3,000 a month, you can say, I want to pay myself $1,500 first because I know I'm going to use that money for X, Y, and Z, and then use whatever you have left for those immediate expenses. The zero-based budgeting method is going to be each dollar in your income is put towards a very specific expense. So you'll pay necessities first, and then distribute all the remaining funds deliberately. And you'll do this until there's $0 left of your income. And this may involve tracking every single purchase and can be a little bit tedious, but if this is the kind of structure that works best for you, then we would definitely encourage you using that method. Okay, so we're going to talk a little bit about savings. So savings is money set aside for your future. And we'll talk about savings versus checking accounts. And I'll talk about a little bit about CDs and money market accounts as well, just a brief overview of those. So first of all, savings versus checking accounts. So checking accounts tend to have low or no interest. And this is just in general. So it's going to depend on the institution. So most checking accounts will come with an ATM or a debit card. This is designed to be a transactional account. So there's usually no transfer limits. Typically it comes with a checkbook, or you have the option to order a checkbook. And then there may be maintenance fees and or a minimum balance requirement. Occasionally these can be waived if you meet that minimum balance requirement. Just make sure you read those terms and conditions before you open an account. And then, so savings accounts, they're designed for saving. So they have the higher interest rates. So that's going to be, the money you put in is going to be making money for you. Typically, savings accounts do not come with a debit card or an ATM card. They don't generally have a limit around 6 transfers per month because they are not designed to be a transactional account. They generally do not come with checkbooks. They may have maintenance fees and or minimum balance requirements as well, and they're usually a little bit steeper than the ones of the checking account. And then there's also possibility of tiered interest rates depending on the balance that you have in your account. So certificates of deposit and money market accounts, these are, some special types of savings accounts that might get you some more bang for your buck. So a certificate of deposit is an account that comes at a fixed interest rate, whereas checking and savings are generally a variable interest rate, meaning it can go up or down depending on the market rate. So CDs, they'll generally be one specific rate, and they will lock you in for a specific term. So typically it's going to be anywhere between 6 months or 60 months, somewhere in between there. So those funds would be locked in, but generally at a much higher interest rate, which is making them, tempting. That's kind of the motivation behind them there, is that high interest rate. And generally there is an early withdrawal penalty. So if you sign up for a 60-month CD and you decide, after 10 months or whatever, you need the money, an emergency has come up, generally you are able to withdraw those funds, but they will have a penalty, usually in the form of interest. And then there also may be a minimum deposit requirement for those. Again, it does depend on the banking institution. And then money markets are kind of like if a checking account and a savings account had a baby. So generally they have higher interest rates than checking accounts, but lower interest rates than traditional savings or high yield savings accounts. But these ones typically come with an ATM or debit card. And like I said before, they might have a minimum deposit amount, they might not. So I think the benefit here of this account is going to be if you want something with a higher interest rate, but you still want to be able to access those funds freely, like with an ATM or debit card. Okay, so then credit and credit reporting. We're going to talk about what a credit score is really quick, credit bureaus overview, and then the credit reporting. Okay, so credit score, what is it? It's a 3-digit number that predicts your likeliness to pay back creditors. So higher scores are generally better, and banks and other lenders will use this number, among a few other things, to determine whether or not they will give you credit. So credit is typically used for home loans, auto loans, credit cards, and maybe even sometimes renting apartments. They will do a credit check. Not all, but some do. And so a good credit score, this is what it typically looks like here. Excellent is usually anywhere between 800 and 850, where bad goes all the way down to 300. Each credit bureau does have their own proprietary scoring method, meaning these numbers might vary slightly depending on which credit bureau you are looking into. But in general, this is pretty average for those numbers. So if your credit score is somewhere between 750 and 850, you're in the excellent to very good category. You can expect to be given like the lowest terms on your loans, which is good, like the lower interest rate, and generally the better terms there. So if you're good to fair, you will be eligible for most of those loans, but they will give you probably some more so some more steep interest rates on there. And then if you're poor to very bad, they'll either offer you an extreme amount of interest, or they just won't offer it to you at all. So there are three main credit bureaus, and these are the companies that come up with this 3-digit score that makes up your credit score. There's Experian, Equifax, and TransUnion. They take a lot of things into consideration when coming up with your score, but these are the three main ones that most banking institutions will, or other lenders will look at these. So a credit report is different from your score. The report is exactly like it sounds. It's a report of your credit history and will show everything that we can possibly find. And I say we as in the government. So a credit report shows your current address, your past addresses, current past employers, any open credit accounts, on-time payments, late payments, and of course you are entitled to one free credit report a year. And you can actually find that online if you go to Experian's website, TransUnion, or Equifax. Any of their websites, they should have information there on how you can obtain a free copy of your credit report. So what contributes to my score? So like I said earlier, on-time payments is going to be the number one contributor to your score. If you have 100% on-time payments, that is going to be the number one contributor there. The credit utilization is probably the second most common thing that creditors look at, which is the amount of credit you use divided by your total amount of credit. So if you've got a credit line of $12,000 and you put $6,000 on that card, you're at 50% utilization. And generally, they like to see that around 30 or less. So that is something that can affect your score as well. So types of credit in your name, credit cards, home loans, and auto loans, they do like to see some diversity there, that you have experience managing other types of loans. Length of your credit history. So when did you first open an account? So for most of us, it's probably going to be in our 20s. And if you're only, in your 30s right now, then your average age of your credit is probably less than 10 years. And that's something you can only fix by just existing on this planet for X amount of time. And then the final thing here also is a number of recent inquiries on your credit. So this is like anytime you apply for a loan or a credit card, that goes on your report as an inquiry. And generally, they only knock your score like 1 or 2 points, and they are temporary on your credit. It's usually like, in the last 1 to 2 years, how many times have people looked at your credit? But it does not affect your score in a major way, such as on-time payments. So I do have some resources here where I got a lot of my sources, a lot of my information. A lot of it is from NerdWallet. They have lots of good resources. They have a savings goal calculator, so you can help yourself come up with what is going to work for you and your budget and your needs, because everybody's a little bit different. And then a little bit more about the Federal Trade Commission and understanding your credit report and what your rights are in regards to that. And then I do have a Q&A section. This is my first time in one of these virtual events, so I'm not sure if Q&A exists or not. There is a chat, though. Okay, so Christina asked, how many times can you apply for a credit card? In general, that's going to depend on like the banking institution. So for example, if you apply for a credit card at the same institution, like today, and then you get declined and then you try again tomorrow, those results are likely not going to change, because the difference between your credit score today and your credit score tomorrow are not going to be that different. Generally, your banks will report to the credit bureau. They report your balance, your on-time payments, about once a month. So in theory, your score changes about once a month, but we always recommend that if you get declined for a card, wait about 3 months before you try again, because you want to make sure that your credit score is up to date with where you are right now. But you could get declined at one banking institution and you could go apply at another banking institution and get approved. They're just all going to have slightly different requirements. but there really is no limit on how many times you can apply. And then what would I recommend for someone looking for a personal loan? Definitely shop around. There's some really great resources like Credit Karma is one where they kind of give you like a rough overview of your credit, and they'll tell you what loans you're likely to be approved for. And then, make sure you're doing your due diligence in making sure that the interest rate and term of the loan are not something that's going to cripple you. So like I said, do your shopping. You want to make sure that just because it has a lower interest rate, if it has a longer term, it might actually end up costing you more money in the long term versus a shorter term and a higher interest rate. So that's something that you're going to want to maybe do the research on and make sure you're getting what's best for you. All right. Well, I guess that's all the questions we have. So it was great chatting, and I will talk to y'all later.